Subdivision 40-E removes the need to calculate depreciation of individual assets in certain circumstances. This reduces compliance costs for taxpayers, as some assets can be combined in a low-value pool. Assets eligible for the low-value pool include low-cost assets and low-value assets. Low-cost assets are depreciating assets excluding horticultural plant items which have a cost of less than $1,000 in the year first installed. That is, in the first year it is available for use. Remember though that this excludes assets that cost less than $300, which are eligible for immediate deduction under Section 40-80. Low-value assets are those assets that have previously been depreciated using the diminishing value method, and the asset's opening adjustable value for the income year being considered is below $1,000 for the first time. Metal by Hand is a small sheet metal business run by Glenn. In the income year just ended, Glenn purchased a piece of factory equipment for $1,100 and a printer unit for the office for $800. Glenn expects these assets to be used 80% of the time for a taxable purpose over their effective lives. The factory equipment is not a low-cost asset because even though its taxable use proportion is $880, that is 80% of $1,100, the actual cost of the asset is not less than $1,000. The printer is a low-cost asset, which Glenn may allocate $640 of, that is 80% of $800, to the low-value pool this year. It's worth remembering here that if a low-value pool is maintained, the taxpayer must allocate the low-cost asset to the pool. Now, in future years, the pooled asset will simply form part of the aggregate opening pool balance, and adjust a single decline in value calculation using the diminishing value method with a 37.5% annual rate is needed. Molly operates a large restaurant and has 100 tables in the business's opening low-value pool balance. Each table has an effective life of 10 years, and they have been acquired in a staggered way over a number of years. Using the low-value pool means that Molly does not have to calculate 100 separate table depreciation schedules. Instead, she simply multiplies the opening pool balance by 37.5% to give the decline in value. This is the key advantage to using a low-value pool. A further way that the low-value pool makes calculating the decline in value simpler is the use of a single rate in the first year in which the asset is allocated to the pool. That is the year in which it is first installed. Low-cost assets allocated to the pool receive a reduced rate of 18.75% on their taxable use percentage. This means that there is no need to pro-rata based on the time of year that the asset was installed. So let's consider if Metal by Hand allocates an $800 low-cost asset and a low-value asset with an opening adjustable value of $800. Both assets are estimated to be used 80% for a taxable purpose. You can see here that the low-cost asset purchased this year and allocated to the pool has a decline in value of $120, which is 18.75% of the taxable use amount allocated to the pool. This is because this is the year in which this asset was first installed. On the other hand, the low-value asset, although this is the first year it is allocated to the pool, has a decline in value of $240, which is 37.5%, because this is not the year in which the asset was first installed. Rather, just the first year it has been allocated to the pool. It is also important to remember that these declines are in addition to the pool decline in value, which was calculated using the opening pool balance. These assets will form part of the opening pool balance in the next income year. We must also not forget that if a balancing adjustment event occurs in respect of a pooled asset, under Section 40-445, we subtract the taxable use percentage of the termination value from the closing pool balance. However, the balance of the pool cannot go below zero. Any excess value will be assessable income. So for example, if the pool value is $300 and the termination value of a pooled asset is $400, then the pool will be reduced to zero and the $100 excess amount will go to assessable income.